So normally what I start with is some economic idea, some underlying economic idea. And then I use the tools of, machine learning, whatever, AI, or whatever we have to work that idea we want to make. But, people often get too caught up in with the tools, but they don't understand that there's actually a reason for why you would use the tools in a specific way. So first of all, we never predict the price. That's the starting point. Why is that so? Because the next price is always similar to the previous price, right? So if we have, if our price of whatever we see is $100, the next price might be $100.1 or 99.9. So it's almost the same, right? So if you try to predict the price, of course, you will always get good results. What we actually want to predict is the return. Don't expect to have one trade and make a large win. I mean, those things happen, but more likely it is that, you make a little bit, here, and then you lose and you win and you lose. And people say, oh, how's it going with the market? It's like, oh, one day it goes up, another day it goes down. We don't know. It just keeps ticking along. And it's more the compounded effect of those small wins generally that is what makes it a profit, rather than predicting one big win.
Welcome to Mentor Chat. I am Vivaswan along with Atharva, and we are here to bring you advice from people who we think are great mentors in their respective fields. In this episode, we are going to talk about AI-based algorithmic or quant trading.
Joining us from Australia today is Dr. Tom Starke. He is the CEO of AAA Quants, which is an algorithmic trading and consulting firm. He has a PhD in physics and previously held positions such as Senior Research Fellow at Oxford University and a Principal Engineer at Rolls-Royce. Tom has since worked in the financial industry with hedge funds and proprietary trading firms such as Vivine Court and Genesis, with a special focus on data analytics and AI. He is an author of over 20 research papers and is a lecturer and faculty member for Quantopian and Quantist.
Yeah, thanks very much. I couldn't have said that better.
Well, welcome, Tom. Lovely to have you with us here today.
Thank you for having me.
So before we move on to the detailed questions, for our layman viewers or for the common man that is watching our videos, can you just tell us in brief what exactly is it that you do?
Okay, so that's actually not so easy. So I'm running a company which is more or less based around automated trading systems, algorithmic trading. So we're basically building systems that trade on stocks and futures markets, and it's all fully automated. And we use, some machine learning and AI to do that. And then we're also doing a few things related to that. So we do consultancy for other companies. We also have an educational program. So it's still a little bit in its infancy, but we're putting out videos and Udemy courses for people that are interested in learning a bit more in that field. I guess that's mostly what I'm doing. And we're also active in the financial markets. So that's probably the three things we're doing.
Right. So recently I came across a type of fund called as Arbitrage Fund.
Mm-hmm.
So Arbitrage Fund basically works because the markets are not efficient, right? So
yes.
Are arbitrage funds one of the safest type of investment for an investor?
So let's just start. That's actually a very broad question. So let's just start first with arbitrage. There's various types of arbitrage. There's pure arbitrage and there's statistical arbitrage, and they're very different in nature. But the other thing is, you say arbitrage works on markets that are not efficient. Basically, if markets were efficient, you could not actually make consistent money with anything. Efficient markets are basically in nature such that you wouldn't be consistently be profitable with your investments. So that's just to get started. Now with arbitrage, there's as I said, there's this pure arbitrage, and it basically means, let's say you have a price in one country, say on the London Stock Exchange, and for the same asset, let's just say the price of gold, or it's not on the London Stock Exchange, but maybe the London Futures Exchange, and then you have the same gold contract in somewhere in the US, and you see that there's a price difference. So you could technically buy the gold contract in one country and sell it at the same time in the other country, and then you make the difference. Now, the difficulty with this is, in general, the markets are now highly automated and extremely fast. So those price differences are very, very rare and very difficult to find. And if they are there, you need a very high frequency architecture to do this. People, you probably heard this, they have initially started using optical fiber cables to do high frequency trading. But then the speed of light in an optical fiber cable is actually only a fraction of the actual speed of light in vacuum. So they moved to microwaves to make it faster. But then microwaves, you have to have a tower every, I think, 20 kilometers or so. So you can't just have a few microwave towers, and especially across the ocean, it's difficult. So people started to use shortwave now. Like, you've heard of shortwave signals bouncing back and forth in the atmosphere, and they use that to do high frequency trading. Now that's the sort of technology you need for pure arbitrage, and it's really basically a race to the bottom technologically. It's very expensive, and it's for even for the average fund, that's very difficult to do. So you need to be very cashed up, and in order to really get ahead in this game. Now, the other thing you can do is statistical arbitrage, and what you do there is basically you look at the relationships between different instruments. Let's say you have two instruments such as Pepsi and Coca-Cola, and you expect them to more or less move in the same way in the market most of the time. And so what you do is, for example, you look at the difference between Pepsi and Coca-Cola, and you actually trade the difference. So for those of you, who know what long and short selling is, so you basically buy one, let's say you buy Pepsi and you sell Coca-Cola, and what then happens is you expect the price of Pepsi to go up and the price of Coca-Cola to go down in relation to each other, and you effectively make money from the change in the difference between the two stocks. So that's called statistical arbitrage. Is that like pure arbitrage? If you can do it, is very safe and you can make guaranteed money effectively. Statistical arbitrage, not so much, because it really relies on this relationship between different assets to hold, and that's not always given. For example, let's say in Pepsi, there's suddenly an insider trade and someone knows something about the company, and then suddenly the price just goes completely in a different direction as the other company, and then you suddenly start losing quite a lot of money. So if you see these arbitrage companies, you really need to ask what do they actually do. That makes a big difference. So I wouldn't say it's the safest way to invest. There's no real safe way to invest anyway. So there's safer ways and less safer ways, but yeah.
Right. So as we move towards a more technologically advanced world, do you think that the pure arbitrage opportunities will just keep on going down and down, and eventually there will be almost no opportunity for pure arbitrage? Because whatever opportunity is there will be like set off by the operating cost or the transaction cost that is there.
Well, there's actually almost a philosophical question. So there's people that think that at some point the markets will just be so efficient that there's basically no arbitrage opportunity. And my personally belief is there's probably always something there, because the markets move for some reason, and not everyone has the same information, and there's
Yeah.
also people acting irrationally. The efficient market hypothesis assumes that people
Yeah.
are always rational, which is clearly not the case, which we
Yeah.
see,
Yeah.
for example, in the US market at the moment. You could argue the price of Tesla is quite high for what the
Yeah.
company is actually worth, for example, or and people get their money and they go to Robinhood and they invest it even though they really don't know much about stocks. So there's probably always opportunities there, and what maybe is happening is that to exploit them will become more and more expensive as technology advances, or they become fewer and rarer. But the thing is, we have better technology now. Back in the old days, it was just equally difficult because we didn't
Yeah.
have the technology.
Yeah.
You had to have good intuition and good lots of experience and a long time in the market. Now you have to have less intuition perhaps, but a lot of experience in programming and
Yeah.
all other technologies, and maybe machine learning and data analysis and all this. And so things haven't really changed. I think they just become a bit more complex technologically, but there's still opportunities, but it's never been easy.
Right. Right. And you just spoke right now about Robinhood investors and
Hmm.
irrational investors. And in one of your talks, you had said that you cannot beat the market simply by using mathematics. So,
um
are
oh yeah.
these irrational investors the reason for that, or there are other factors as well?
Well, that they're really two different things. So when I said this, what I mean is that the market operates in a different way than, say, the laws of nature. So I mean, back in my academic days, when you are a scientist, you work on laws that are basically not necessarily mutable, but when we come up with physical laws, they're
Yeah.
usually around for a while, and of course they're only models of nature. They're not nature itself, but we can make fairly good predictions of what's happening. However, the market follows a very different dynamic, and the dynamic some people describe as a type 2 chaos. So basically, you've probably heard of chaotic systems or nonlinear systems, and small changes in the nonlinear systems often have a very big effect on the
Yeah.
system, which is extremely hard to predict. And in level 2 chaos, what happens is even by observing the system itself, that has an impact on the system, which is basically equivalent to saying that when you trade in the market, when you do one trade, that in
Yeah.
itself changes the market. You observe it, you make a decision, and so the system has an even more complex nonlinear dynamic. And so it's hard to find mathematical underlying equations that can really do this. Now, when I say, oh, you can't beat the market with mathematics, what I really mean is that it's and when I was saying this, I was addressing this to mostly to quants,
Yeah.
to quantitative analysts, and what I was saying is, if you think all you know is your maths, and you don't understand the dynamics in the market,
Yeah.
it's
Yeah.
going to be extremely difficult, if not impossible, to really do something. I mean, ultimately, what we are doing in my firm is very mathematical, to a large extent. However, we always understand the underlying economics of it as well. We are very aware of why we are doing the things that we're doing. So normally, what I start with is some economic idea, some underlying
Yeah. Yeah.
economic idea, and then I use the tools of machine learning, whatever AI or whatever we have to work that idea. So like the machine learning and AI, that they're tools, and
Yeah. Yeah.
I guess I guess, with those tools, just like when you have a hammer and a chisel, you can make a certain sculpture or a different sculpture you want to make. But, people often get too caught up in with the tools, but they don't understand that there's actually a reason for why you would use the tools in a specific way. And that's mostly what I mean. It's like I really want to drill into people, hey, really understand the dynamics of the market and how it all works if you really want to be successful, rather than just thinking, oh, I'm a smart guy, I know mathematics, I go into the market. It's not that simple, actually. and of course, sometimes there's exceptions to the rule, but very few. In fact, I don't really know any.
Can you give an example, a real life example of where there is an underlying economic idea and then you apply models?
Yeah, sure. I mean, for example, just really, really simple, in the US at the moment, we had a big crash, but then the Federal Reserve jumps in and says, oh, look, we bail out all the companies and and you could argue that, all the money printing basically increases the stock price again. There's not really any fundamental underlying economic reason for it, but the economic reason for an increase in the stock prices is basically that, I mean, I'm not say that's technically the case, but you could argue that the Fed is printing money, and as long as they do that, we expect the markets to go up. And so here is your rationale for example, for going long in your investments until maybe the Federal Reserve comes out with a different narrative, and then you go at the other direction. Another thing is, for example, just really simple. In India, when I was in India 2 years ago, some of my students told me that in India you're not allowed to hold short positions overnight. And so what it means is, if people are in short positions, they have to close them before the end of the day. So they're almost forced. And this could generate quite a bit of momentum in the market. I'm not sure that's still the case, but I think that would be, for example, something you could exploit in short-term trading.
Right. So manual supervision and manual intervention will always be required based on fundamental or qualitative changes, right?
Not necessarily. So if you find dynamics that that are good, they can often last for a long time, and they can be quite good. So the systems that we use, they're basically purely automatic. But having said that, there is sometimes manual intervention, because there's times when you get a bad data point, or your server crashes, or stuff happens, and you need to be very aware of it. So when I started this algo trading a long time ago, my idea was that I build a machine that just trades the markets, and I just lie on the beach and have fun and lie in the sunshine. But unfortunately, this has never come to this point. Quite the opposite. A lot of these machines are very, very complex, and they're non-standard, and they need a lot of attention. So it's not the same attention that a trader would use that is on the floor of a stock exchange or in front of a screen, but they definitely need a lot of attention. They need a lot of analysis. So none of these machines is just purely running by itself. You also want to make sure you keep track of what they're doing in order to avoid disastrous incidences, which can happen sometimes, and they have happened before. There's quite a few examples in the history of the markets when companies made programmed the wrong code or something, and then they got completely wiped out.
Right.
So these things can happen.
Just to get a perspective, like how much trading actually in the world is done through algorithms and like automation?
It depends on the country. It's actually not so easy to estimate, because a lot of the trading activity is for example, high frequency trading, and that accounts for a lot of the volume. But in some sense, it's to a normal slow individual trader that trading activity is so fast that it's basically almost unnoticeable. It's just like coming and going, coming and going. But if you count that in, I think, there's at least 50% of trading volume in the world now is probably algorithmic, and in some countries it's probably up to 80%. So machines really start to dominate the markets, which is what you expect. We live in this sort of world, and financial markets, in a sense, are perfect for that sort of activity.
So
Right.
in terms of capital, how much? So again, it would be very hard for you to like give the actual amount, but what is the highest amount that you have seen that has been allocated to a machine, like to invest on by itself?
Oh, there's really no limits. I mean, when you look at the big the big asset managers and funds, there's trillions basically. I mean, it's you can't say how much money is allocated to a machine. It's more like the machine makes trading decisions, and has a pool of money and assets, and then makes changes. Usually a lot of the large asset managers, what they do is they basically allocate whatever money they have to a large portfolio, and then all the machine does is it just rebalances the portfolio according to certain criteria. So it means basically all the money they have is essentially traded algorithmically. So I
So
think most of the big asset managers work that way. There is still discretionary decisions, but they're almost more like, we have say algorithms for regimes that are very volatile or not so volatile, and they make these higher level discretionary decisions, but most of the trading activity is actually algorithmic.
okay. So when I was asking initially about the amount of trading done, so I had read that in 2016 there was this survey in USA that 80% of 60% of the all of the trading was, I guess, through algorithm. But I guess this is the high frequency trading type of things where the trading is mostly rule based. But what you do and what is now the current trend is that we are using AI and ML to make better decisions, right?
Mm-hmm.
So what do you think? Where are we in using as a world, as a technology, in using AI and ML to support our decisions?
Well, I mean, with the AI, oftentimes artificial intelligence, in my opinion, is still a little bit overrated, in a sense that even if we use it, we still make very discretionary decisions in what features we use, how what parameters we use, how we implement everything. So it's not like you can actually switch on a trading machine and it just runs and makes money, because when you think about it, if another person would know what machine you use, they would switch it on as well, and boom, you straight away have two competing machines. So one of them wins and one of them loses. And you know how technology moves really fast, so there's always going to be new machines. So it's not a question of just switching on a trading machine and then it just makes money. You have to come up with ever increasing intelligence and smarter systems and faster systems and all this. And I mean, in a way, that's a good thing, because what that means is it keeps us in our jobs, right? If it was just as
Yeah.
simple as just building a big machine that makes money, then you know we would not be able to do our jobs anymore. We would just build a machine, and that's the end. And then one person makes all the money, and everyone else goes empty. But nature isn't like this. It's an evolutionary cycle, really. In the machines, and as I said, I think we we mainly use them as tools for what we want them to do rather than actual, a means to an end. There will not be a machine that you switch on and it will ultimately make money. So it's really just a question of, we have tools, we have a market. What do we do with these tools in order to help us making the best decisions possible? Even the decision what type of AI you use is a discretionary decision, right? And there's no easy answer to that at all. In fact, a lot of our trading is still more based on quite simple machine learning. A lot of AI systems have drawbacks that are detrimental to the market, and probably the biggest one is that neural networks really heavily overfit. So what happens often is, you train a neural network on a certain type of market, but as soon as it encounters a different type of market, it's just not working. And again, that overfitting problem is very difficult to resolve, and people are still struggling to really come up with good solutions for this. In that sense, financial markets are very different from, say, a speech or image recognition or something like this, because, first of all, in financial markets, you have an incredible amount of noise, and then you have these really, really extreme regime shifts that happen. When you do image recognition, generally faces are faces, right? And usually, if you have pictures, they're not too bad. You get reasonably good images, and in finance, the equivalent is if you try to recognize an image which has only 5 pixels, and those pixels even are really noisy, and they change as you look at it. As you look at the image changes even. And so how you gonna how do you deal with that? This is what you're up against when you use AI in the financial markets effectively. So you have to be pretty smart about how you approach things.
Right. So for people who are wanting to go into this field, so what are some of the prerequisites that they should need? Like what amount of financial knowledge, what amount of knowledge in, let's say, AI and ML? Is knowing math a hard requirement? Like what I'm trying to ask, like what type of knowledge one must have before venturing in this field, so as not to do anything stupid? Like, is the knowledge of time series and all these things very essential?
Um, well, it's actually a good question, and I get this quite a lot now. It's hard to answer because it depends in what type of environment you start. So there is a big difference between, say, working for a small proprietary trading firm or hedge fund, or working for a large institutional asset manager. And the requirements are in fact so different that it's really hard to give a good answer to that. Now, I think that's my personal view on it. If you're good at programming, that's very, very helpful. So if you have a really solid programming background, that's probably the best starting position. However, it's good if you have done at least some trading yourself. I would say to at least understand the basics of the financial markets. But then every firm has different requirements, and some firms require jack of all trades. They need to know everything a little bit. Other firms they want pure quantitative analysts that don't know anything other than their say options pricing and stochastical equations. In our case, me and my guys, we're all knowing, we all have a very wide background rather than being very specific. So we all have maths, programming, and a bit of financial background as well, because we want to basically keep what we're doing small, and so everyone has to do a little bit of everything. Now, I think oftentimes what is a good idea is to work your strengths and get a bit of what I call domain-specific knowledge. So, if you're say really good at programming, you really want to get some understanding of financial markets, or even just economics in general. So for me, usually when I'm driving my car, so I often listen to blogs on macroeconomics. That's something I'm quite interested in, and oftentimes good ideas come from that rather than thinking about the maths of it. And be, in my opinion, be a bit more broad rather than very specialized. But yeah, it's really hard to say. Like, oftentimes when you're good at something, then you have a good chance of someone wanting what you do. Now, maybe what I can say is I've recently had a fellow who contacted me, and he asked me for my opinion on his model. And I said, well, I'm not so sure what you're doing is a good idea, because I've done this many, like a decade ago, and it wasn't really working back then. And he said, well, I just need it more for an academic reason, and not so much, I don't actually really want to make money with it. And I'm like, I think, if you don't want to make money, or if you don't come in with the idea that money making is a thing, then you're wasting your time. I think probably the most important thing is, when you do quantitative finance, it's about the money. It's about, making money in a competitive market. And if you don't feel like that's something you want, then you probably waste your time. It's probably better than to go into science or engineering and use your skills there, because that's it's actually, in my opinion, a bit of an unfortunate fact that a lot of scientists in fact go into finance, where we might need them more in science. But so here we go. That's our society, and I'm definitely one of those people. So oops, you just disappeared. So yeah, I feel, if you really want to get into this, probably having a focus on making money is not a bad thing. So I would recommend that.
So focus on making the money and have like tools like AI, ML or maths in your like backpack, so that you can use.
The more
So
tools you have, the better. If if you have good tools, but it's not just about the tools as well. Like, the people that are probably the most successful are either the ones that steal from others, which is obviously not what I recommend, or people with really creative ideas. And that's something that I think is what people often underestimate. If you have some really good ideas, that can be extremely helpful. But of course, you need the tools also to implement those ideas. So combining or putting a good amount of creativity in the mix can be very, very good. And when you actually look at what people do in the financial markets, some of it is extremely inventive and interesting. And so, if you want to do this, then basically just be creative as well, rather than just a technologist.
right. So you mentioned about having an economic idea and then doing. So what to do? We basically tell the algorithm. So we will dive into what is actually being done by the algorithm. So let us put the model or the algorithm in a black box for now, and understand what the model is actually trying to predict. So what are we actually trying to do with this quantitative trading? So is predicting the price of the stock the only thing that we are looking at, or do we look at many other outputs, and then based on those outputs or their weighted sum or something like that, we make a final decision?
So first of all, we never predict the price. That's the starting point. Why is that so? Because the next price is always similar to the previous price, right? So if we have, if our price of whatever we see is $100, you know, the next price might be $100.1 or 99.9. So it's almost the same, right? So if you try to predict the price, of course, you will always get good results. What we actually want to predict is the return, because if the price goes to 100.1 and we're short, we lose. If it goes to 99.9 and we're long, we lose. So even though we have predicted the price correctly because it was very similar to the previous price, it doesn't help us. So we're actually predicting return and market direction. But it's not quite so clear cut, because a lot of the time we're not really looking into predicting a single price. What we're actually doing is we're saying, well, we have a whole lot of different assets, let's say 100 different stocks, and we say, well, you know, we do some numbers and we get some signals, and then we say, well, we have like a really small probability of you know, getting the direction of the next price move correct. And if you do this for many different instruments, you know, all the noise will basically cancel out, and what's left over is that little bit of edge that you have in the market, that little bit of predictiveness. So a lot of the time, it's not about making a grand prediction. You know, it's a bit like I don't know if you heard of this idea of the Kelly formula. And so the idea is effectively, if you have a coin that you know, where you have a 51% chance of heads and a 49% chance of tails, if you just do one coin flip, your chance is almost half to win or lose, right? If you put all the money that you have into it. But then let's say you have $1,000 and you have this 51 to 49 chance, but let's say you have unlimited amounts of coin flips. You know, how much money would you put into every coin flip? And it's an interesting question, and it turns out the answer is about 2% of your bankroll. So if you had $1,000 to start with, it's about $20. And so if you put about $20 into every coin flip, even though your probability of winning and losing is almost equal, over time you get this compounding effect of profit, and you maximize your return over time. Now, in a sense, we do the same in the markets. We assess what is our probability of winning and losing. We're not really predicting exactly where it's going to go. We just go, okay, this is approximately you know, how much money we should put into this trade based on you know, a small probability of being right. And so this is probably the most important part of it, rather than, you know, like the prediction of the market direction is one part, but more importantly is the question, how much do we invest in every single trade? Does that make sense?
Yeah. So,
yeah, so it's a law of large numbers, effectively.
Right. I get it. So basically you divide the amount into like small parts, and at every, like you mentioned in one of your lecture, like treat it as a game and see what, so try to learn from every game. So
Yeah. I mean, that's the sort of idea of reinforcement learning. But also, you know, really don't expect to have one trade and make a large win. I mean, those things happen, but more likely it is that, you know, you make a little bit, you know, here, and then you lose and you win and you lose. And people say, oh, how's it going with the market? You know, it's like, oh, one day it goes up, another day it goes down. We don't know. It just keeps ticking along. And it's more the compounded effect of those small wins generally that is what makes it a profit, rather than, you know, predicting one big win. That's much harder to do, and maybe Warren Buffett can do that consistently, but I definitely wouldn't consider myself as smart enough to do this. So we have to use computers to do the same thing.
Oh, Tom, speaking of it, how much time frame are we speaking about when we talk about winning or losing in a particular time frame?
Or that is, any time frame really. So some people, they do the high frequency trading and the trade lasts for a second or 2 seconds or something like that. But then, there's people that do quantitative trading as well, where the trades last 3 months or even a year or something like that. So it's not really a question of the time frame. It's more a question of, well, every individual time frame has probably different dynamics and different rules. So let's say in the US, the S&P 500, when you look at the shorter time frames, let's say an hour and less, then the S&P looks actually quite mean reverting. So it's got more of a mean reversion or a negative autocorrelation with it. Whereas if you go to larger time frames, the S&P 500 is actually more of a trending instrument or index. So it really, like, the dynamics can really change depending on what time frame you're looking at. It's not the same in every time frame.
Right. But when you said that we have to have a economic idea when applying like AI and ML as a tool, so do we also need to fix the time frame first before uh, venturing into like predicting it? Is it equally?
Yeah. Well, you can trade multi time frames. I mean, we can do this, but it's not necessarily straightforward. There's a lot of things that come with different time frames. So, for example, if you trade at a really short time frame, you also have to be really worried about your execution. As you maybe know, in the market is effectively an auction, and it's got a bid and an offer price, and there's a spread between them. And so usually, if you buy at the market, you buy at a higher price and you sell at a lower price. But what you actually want is the opposite. You want to buy at the lower price to sell at a higher price. So that what we call a bid-ask spread. That's if you trade in really short time frames, like say on a minute or 5 minutes or so, that's a real concern. But if the spread, if you trade like for a year in a time frame of a year, and your profit expectation is in the double-digit % range, then this little spread doesn't phase you at all. And so trading different time frames, there's very different rules, and it's really important to be aware of that. And normally what you do is, when you have a trading strategy, it's usually in a very specific time. It applies to a very specific time frame, and not necessarily multiple time frames.
Right.
Or we call that granularity. It's like the granularity is like a minute, an hour, a day, a month.
Right.
So.
And now speaking about the like again the model as a black box, we spoke about what are we trying to achieve, but what does the black box take as the input? What are all the things that you can possibly feed into the algorithm or the
Oh,
model?
well, almost anything really. So where do we start with this? So there's really no limit of what you can feed it. Now the question is whether it's a good idea or not is not necessarily obvious, but you can, my favorite example was, there was guys that looked in the US. You can see people's if they if they want a golf handicap, they have to publish what they did on the golf course, and from that you can actually backtrack how much time a week they spend on a golf course. And what they did is they found a really strong negative correlation between how much time a CEO spends on the golf course and how well the company is doing. So basically, they use those golf scores or those times a CEO spends on the golf course as an input into their trading model. and it was quite successful. Or another famous example was a US company. They basically took satellite images of department stores in the US and the park and how many cars were in front of their in their parking lots in front of the stores, and they found that certain companies, over time, the number of cars on their parking lots started to drop significantly, and they basically could infer that the company wasn't actually doing that well, and they were able to predict the bankruptcy of this company quite ahead of time using those satellite images. So that's something that you could use, and there's a whole lot more, and some people, they look at weather patterns. They found that in some, if you have a large company with a large production facility, then if the weather is nice, people tend to go home a bit earlier and maybe work a bit less hard, and so the production goes down and so on. So there's all these really what you call alternative data that you can exploit. But then there's also things like simple things like moving averages and maybe momentum. Then some people use technical analysis. They use trend channels, or they, maybe you've heard of support and resistance lines. There's also really interesting things like what are they called? I forgot. There's these. Oh yeah, Elliott waves. And the thing with those things, they're very subjective. So some things that like a moving average, you can actually generate that by a computer, and it's always going to be the same. Whereas a trend channel is a very subjective thing to draw, and so some people would say that this type of technical analysis is alchemy or black magic, and it has
What
really
is
no
the trend?
basis.
What is the trend
Alchemy.
channel? No, what is the trend channel or the?
And so it's basically, you've probably seen this. Some traders, they take a chart and they draw lots of lines on it. They draw like horizontal lines, and then they draw like diagonal lines, basically indicating the trend of an asset. And they basically say, oh, if it breaks out of that trend or that channel, then the price must really go up a lot higher. But what you can do is you can actually use just a really simple random number generator, and you can generate just randomized price charts that have absolutely no specific direction. And every single one of those price charts that you can draw with a random number generator will have all those features in it that technical analysts love, like head and shoulders patterns and double tops and diverging channels and all that sort of thing. But because it's a random number generator, none of this has any meaning. So I'm not saying it doesn't work. That's not what I'm saying. But from a quantitative trader's perspective, it's probably not the way to go. I'm sure if you are a trader that has a lot of experience in the markets and you use these channels to clarify your understanding of the market, then they're probably useful. But for me personally, as a quantitative trader, I wouldn't touch it.
In one of your videos, I also heard that you don't consider volume as a very nice input to give to a model, because. So can you explain a little more about that?
I may have said this in a very specific context. I think you can't necessarily say that. Like, volume is definitely something that is important in trading. When you see volume ticking up, you can infer certain things from that. When I said this, it was probably, I can't remember when I said this, but it was probably in the context of a specific trade that I was explaining, or something like this. So volume is definitely important, specifically if you go to higher and higher frequencies. Then trading volume makes a big difference often, because if you go really fast, then if you need to put on a really high volume trade and there's not enough volume in the market, then you can move the market quite significantly, which is not necessarily what you want. But then there's certain other types of trades where volume is probably not so important, and it's probably something that I explained then. So I wouldn't say this categorically.
Okay.
Right. And like, what is the importance of ratios such as, say, price to earning or price to book, or say return on equity and such percentages? So does that carry a high weightage in algorithmic trading, or are there any other ratios that are more important, or how does that work?
So you call this more fundamental trading, and it's some people think that in these days with money printing and central bank intervention, those fundamentals have become almost useless, because companies, if companies just get bailed out, how much is it worth to have fundamentals? Because if or even in, was it Hertz went bankrupt, and yet the stock price jumped by a significant amount because people didn't know what they were doing, and Robinhood was trading. And again, that Robinhood trading was probably based on the fact that the US paid a lot of people unemployment money that they then used for investing. So company fundamentals clearly have got no bearing on the price of those stocks, or not very much. Having said, and so that's what you probably would call a not orderly market. Having said that, perhaps there are still other markets other than the US where fundamentals still play an important role. And the other thing is also fundamentals probably have a lot more important role to play in the long run. So what people often do is they use machine learning to scan large parts of the market and scan it for those fundamental ratios, and then look for patterns of those numbers that might indicate that a company is going to do well or in the future, or probably more often than not small companies that might go bankrupt. So those ratios, I think, it's not something I do, but I think machine learning is often used to filter out firms that have a higher probability of going bankrupt. So that's definitely something that might still be interesting.